Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
News alert, news alert. Baby boomers face lasting retirement hit as extended stock rout. And not to be outdone by that article, the best ways to calm client fears. Here's an idea. Don't lose all their life savings and have a sell discipline. Just a thought. And no wonder they're pissed and they're freaking out, but never fear. Structured notes are here. Structured notes are here to save you because they're structured. They're backed by something. They're a backed note. Oh, but stifled to pay nearly $133 million to risky structured notes. Folks, oftentimes they structure them to hide the risk. That is the point. That's why they have to wrap the note and cloak it and base it on interest on some underlying asset. So number one, you better know what the underlying asset is, and you better know who the guarantor, who's guaranteeing that note. You're only as good as your guarantee, right? But alas, you don't even have to worry about that because now we've got buffered ETFs. They're the be-all, end-all. They're like the indexed annuities, but without the annuity, right? So we got these buffered ETFs, the be-all, end-all, and they go point to point. You can't lose money, and you go from point to point for 1 year, and then we rebalance, we reset. I just hope those specific points, that 1 day a year or that 2 days a year, is the right specific time to reset, or hypothetically, are you still in right now and you're writing it down and you go and you write it down for the route and then you get to reset. So yeah, you didn't lose money, but you didn't gain money. You see how clumsy those are, those products, not strategy, products, packaged products. Folks, being a fiduciary isn't enough. That's just how they get paid. You still have to have good strategies. If you've got a fiduciary that's pushing products and annuities and stuff, call me. Anyway, Barry Ritholz, this is not the time to buy. Thanks, Barry. This article's actually about 4 days old, so maybe it is time to buy now. Maybe things have changed. That's why you can't really trust the news because it may be already outdated. And lastly, my man crush Gundlach, the 10 predictions for 2025. Now, both Ritholz and Gundlach's articles are very interesting, but neither of them help you with your money, right? They don't make you help you with your money. So don't be Wall Street's widget and don't be the 99%er with a pie charts or us portfolio. Be a 1%er. All right. So they even have these pie charts of us at the premier Wall Street firms, these intelligent portfolios, these AI portfolios, right? I'm sure you've heard about them. So their idea is all this diversification will save you instead of getting defensive. Okay. So if you want to have our stance, or if you want your money to look exactly like our money, our current stance, because we manage money right along with our clients. Our portfolios, our family portfolios look just like the clients. It's a much better way to invest, and it's a much less risky way to invest, in my opinion, if you measure by drawdown. We've never had a bear market. We have a sell discipline. We manage risk. We manage drawdown. Anyway, now and so all those articles are in the mailbag. You can go check them out. But in lieu of those are the show notes. Excuse me. In lieu of a mailbag this week, I actually got a call from a client. It was a very interesting call. It was a good call because we've got taxable accounts and we've got some monster gains in NVIDIA because we've had it for a long time. But NVIDIA has been taken to the woodshed. And so for the IRAs and non-taxable money, we sold it. We booked those huge gains. But for the taxable accounts, we're able to hedge, and we bought a hedge. And he called me and he said, aren't you just exchanging short-term gains for long-term gains? I mean, wouldn't you prefer the long-term gains? Because now you just, if the stock pulls back, the hedge turns into a short-term gain, but now you lost a little bit of the value in the long-term NVIDIA. He's saying, why wouldn't you just sell NVIDIA? You're exchanging a worse tax rate. On the surface, folks, that sounds logical. Sounds really good. But in reality, what happens is, first of all, he's looking at it with first of all, you can't ever look at it with hindsight. You got to do it in real time and going forward. But if you think NVIDIA or any stock, or say we have 5 or 6 stocks that Don has carefully assembled and put together, and we think the market's getting weak and starting to roll over, but it could just be a short-term pullback. It may not be a correction like now. It may not be a really big market event. It may just be a short-term 4, 5, 6%, 7% pullback. Well, we can just throw on an inverse short-selling ETF, just hedge that position or positions in the short term just to see and wait and see. And then if the market does snap back, then we didn't have to sell those positions. We never triggered those big long-term gains. Even though they're the long-term gain rate, they're a much bigger gain to pay, right? And now we actually have a little short-term loss in that hedge, or maybe break even, you don't know, but even a short-term loss that we could offset against other gains. The whole point of a hedge is you don't know and you're parking it in neutral. See, he's assuming that we knew the market was going to go down. It looked like it, probabilities, so we wanted to throw on that hedge. Now I'll go you one better. We throw on the hedge, we park it in neutral, or a partially hedge if it's partial, but if it's full hedge, it's neutral. So when the market goes down, your hedge goes up in value, you got a short-term gain, but then this stock starts to go down, so you give up a little bit, but you're able to hedge for the short term. Now, if that stock continues, or stocks, if you're hedging a bunch of stock, continues to go down, they will get triggered. Their own individual stocks will get triggered. They'll get taken out. And now you're just left with the short position that is now like a long stock position, but you're trying to make money on the market going down. In other words, your hedge is now turned into a money-making proposition where you're speculating, you're trying to make money, just like a long stock, okay? You're now short the stocks, or short the stock market index or an individual stock if you're using an individual short ETF, or you're shorting individual stocks. Whole point is now you've changed. All right. We have made some wholesale positions, fundamental changes in the overall portfolio, and we've jettisoned just about every one of our individual stocks. And now there's just a few sectors that we're focused on. So remember that pie charts are us. Remember I told you that Wall Street thinks it's their money, and they're taking your money and making it their money, and you're the input. They're taking your money and they're diversifying in emerging markets, Europe, the bonds, the muni bond, the tech company, the stocks. They're diversifying over all their real clients that, they're an investment banking firm. They're spreading it to all their clients, right? So you are the input. You're not the client. You're the product. I want to have just the best areas, just the strongest areas. And if no place is strong, which happens every so often, and you're in an ugly bear market, you want to go flat. You want to just be cash or treasuries, or maybe just gold and treasuries. In any event, we're not that, and if you've been listening to this podcast, we archive everything. You don't have to listen to anything. You can go back and listen to what I said. I told you for years, don't own emerging markets. Don't own Europe. It all looks like trash. America's the best place to be. And why would you be any place else if we're the strongest? Because you've got the currency risk too. You got 2 risks internationally. Well, that thing has changed just in a week or 2 weeks. Things are starting to look much stronger, and it's looking weaker in America and stronger overseas. So are you supple enough in mind to be able to switch that and completely change your allocation? Or are you willing to actually go to 50, 60, 80% cash, or even 100% cash, and just instead of having that total pie charts or us portfolio? Don't be a 99%er. 99% of Wall Street, I don't care whether you call it target date fund, asset allocation with some rebalancing, lifestyles fund, 60-40 balancing, it's all the same nonsense. There's more stocks than there are mutual funds or ETFs that you can. There's more ETFs and mutual funds and ETFs than stocks you can put in them. Let me repeat that. There's more mutual funds, more products that you can stuff the stocks in. That means you got that diversified pie chart. You own Microsoft 6 times in these different funds. It's the illusion of diversification. By the way, when it hits the fan, it all goes down together, and you don't want diversification. You want cash. Anyway, enough said. I beat my bully pulpit. Let's go to Team Revere. Don, tell us what's going on and tell us what you're seeing in the markets and what is price telling us. Price is truth.
Save me, Obi-Don. You're our only hope.
Oh, there you go. That's making a headline. Obi-Don Kenobi.
This is what we're saving. This is what we're saving you from. This is the entire existence of Revere is designed to prevent these severe losses to our clients' accounts. They're especially critical approaching retirement. I put this chart on the heading page, the splash page for our video last night, and it's especially critical. Yesterday, we hit the minus 10% level on the S&P 500. This is what the news media considers technical correction area, which is 10% off of the highs. 10% off of the highs is no problem whatsoever. In fact, it's occurred 53 times since 1950. And we don't so much concern ourselves with that 10% drawdown, but what we do concern ourselves with is making sure that what's on this chart doesn't happen to you, especially if you're approaching retirement. I talked about the 200-day moving average and then a 2 ATR or approximate 3% envelope. We had one close below that 3% level yesterday, Thursday, and today we are having a strong day. Now, there's an argument if you look, it's not day 4 or day 3 if you look at the S&P 500 because we undercut Tuesday's levels on Thursday. It's also not eligible for a follow-through day because we undercut on the NASDAQ 100 on Thursday as well. But if you go to the NASDAQ composite, we did not undercut. And you could argue that Tuesday was a day 0, a pink rally attempt day on the S&P 500. It closed slightly below the level that you would prefer it to be. But there is some people talking on Twitter and some canceling people saying today could be a possible follow-through day. A couple of a percent on one particular day or a 0.1% undercut doesn't really. It's like it's so close. If the market would have closed 5 minutes earlier or 5 minutes later, that you might have had a different outcome. We obviously have rules that we have to go by, but we have to take everything in its proper context. And we are having a strong day today. We're seeing some slight change in character. We've been identifying the leading names. I talked about a few of them in the video last night. And what we're seeing in some of them is good action, but what we're also seeing in names that have been beaten down is that they're getting back above their declining 8-day moving average. And that's the purple line on here. This is the NASDAQ composite, and I pointed out in Thursday night's video that this has been controlling the entire downtrend. We're still below this 8 EMA on the NASDAQ 100 and on the S&P 500, but we're always looking for signs of relative strength. And some of the stocks that we're monitoring on this 100-plus stock list that we have are getting back above that level, which is one of the first signs of possibly putting in a bottom. Now, we're not going out and haphazardly buying everything just because of that, but it's a mild change in character today. We're not even above Wednesday's highs, so nothing to get overly concerned about. But you can't lean so far bearish or bullish one way or the other that you completely rule out the other side, and that's why the market is designed to fool the masses so often. But basically, in a nutshell, watch the 8-day declining moving average on anything that's on your leaders list. The guys are gonna talk about some things that have stood out to us, including some where we took tiny positions on as a starter, and we take it day by day. The important thing is that you don't get hit in the side of the head with this, and that was the point I was trying to make in Thursday's video. That if you haven't, we had a client call. A friend of hers called her advisor. The advisor said, "We're not selling anything. We're in this for the long haul." Well, that's great if you're an oak tree that has a 200-year lifespan, but people don't. And this person was concerned enough about it that they called their advisor. 99% of the advisors will shut the client down, just like this one did. We are the rare exception that has a plan. We would agree with the person. In fact, we would have said to the person, well, that's exactly why we've been lightening up since February 21st, because we recognized we don't wait till the market is down 10% or 15%. All of our stops in our individual positions got hit on 221, and that was the day we started to break key moving averages, starting with the 21-day moving average on the S&P 500, and then you can see just riding the 21 and the 8 lower. It's just a matter of watching from a technical standpoint what's going on with the market, maintaining an eye on technically and fundamentally sound stocks that are either holding up or are showing fundamental leadership characters that if the market rights itself, that they could form the right sides of their bases and break out. And that gets to the second part of what we are looking for. Just because you have a follow-through day doesn't that should be accompanied by a handful, 10, 15, 20 quality names breaking out of sound bases. And we just really don't have that right now. For an example of a sound base, look at silver. This was a beautiful cup and handle, broke out yesterday, mild pullback today off of the breakout, high volume on the breakout, lower volume on the pullback. This is what we would love to see top-notch stocks acting like. Growth stocks acting like, but it's just not there right now. And that doesn't mean to say that the bottom's not in, Dan. We don't predict here ever because we've been wrong so many times, but we're always wrong small. We
it's okay to be wrong. It's not okay to stay wrong.
Exactly. Right. It's okay to be wrong. It's not okay to stay wrong. So
I've got a question. I've got a question for the listener. So Don's saying all that stuff, right? He's talking about 53 times since 1950. We've got a data. We've got that's his actually college degree. He was data scientist, and he actually backtested a lot of our stuff to see if there's a better way to do it. And we're constantly doing that. But what I'm asking you is, are you supple enough in your mind to believe the market from here today could go up 30 or 40% in the next 2 months or down? I mean, I'm scared to death, and I feel like it's going to go down 30%. That's why I've got to have rules, because it could go up 30% from here. So my question to you, the listener, is, does your advisor sound like Obi-Don Kenobi? Or is he asking you for a tea time and just telling you to stay the course? It'll be all right. The market always comes back. Maybe a decade. There have been lots of historical periods where the market, it took a long time. By the way, did you know back after 1929, after the crash in 1929, for 3 decades, stock traders, stock investors, people that invested in stocks were known as speculators. They considered it gambling, like they didn't have Vegas then, but considered going to Vegas. That's what they thought about it, right? Since 1980, since the Reagan era, and interest rates dropped, and you had the longest bull run in history for 20 years, essentially, if you ignore the 1987 flash crash, right? All right? That's the longest bull run in history. People lived through that, and that's where the buy and hold story started coming up. So a lot of these stories actually come out of people's experience at the time, but history may not repeat itself for your life cycle. In other words, we've only got 20 or 30 years to aggressively save and then 30 years to live on it. That's what Don's talking about, the oak tree. The market's time cycle may be too short for your oak tree life cycle. You may not have long enough time to recover. And the closer you are to retirement, the more a sell discipline is absolutely crucial. It's still important at 30, so you can retire at 60 instead of 75, right? but it's important. And there's studies that show that modern portfolio pie chart theory is random. It's called sequence of returns. Google it. You don't have to believe me. I can give you real examples about why that turns it into random. At the end of the day, the pie charts are us. You may have $1 million or you may have $500,000. The variance is not 10%. It's like 50%. So don't get a Lie Charts Are Us from the Pie Charts Are Us advisor. Listen to Don. All right, Don, I got off my bully pulpit. Save me, Obi-Don Kenobi.
Couple stats I'll close with, and it really supports the approach that we take with trend following. The average monthly return of the S&P 500 going back to 1970 is positive 0.73%. If you spend the entire month above the 200-day moving average, the average monthly return is positive 1.69%. If you spend the entire month below the 200-day moving average, the average monthly return is negative 1.11%. Now, if you're living any aspect of your life and you knew what average was, what above average was, and what below average was, in any situation where you're making a decision, don't you think you would go with above average? I don't know anybody that wouldn't. But Wall Street has brainwashed Main Street into thinking that you can't time the market and you got to stay in our products through thick or thin. And the only reason for that is that they can't collect their fees if you're not in their products. So we'll close with that stat and we'll take it over to.
Well, hang on. One other
fellas.
question. Don,
all right.
One other thing. Right. I want to bring up one other point that's really important. Because, folks, that modern portfolio theory, that pie charts are us strategy is going to give you about 7% return overall. And then it also is going to have big drawdowns. So the timing of when you need the money is very variable. It's random. That's the risk. We're talking about sequence of returns. But the other risk is longevity risk. People are living longer. Look, back in my parents' day, people smoked and drank and they retired at 65. They were dead at 72. People are living to 90 now. That 60-40 pie charts are us. Target date, lifestyle, 7% is not going to make you enough money unless you've got a lot of money or you save and you're a spinster and you don't have a lifestyle while you're actually living, right? Then that is not good enough. That's not going to work. You're going to be a Wall Street greeter till you're 80. All right, Don, sorry.
All right, let's start off with Ted today. He's going to talk about, I mentioned pilot buys a little while ago. He's going to talk about 3 pilot buys that Connor and he took in the TurboTection portfolio yesterday. Take it away, Ted.
Right. So as Don talked about in his general market brief, talk about as markets correct, pullback correct, we're heading to bear markets, we start looking for relative strength as well as maybe do a little bit of shorting at the same time. But it's really critical, as Don said, that you always maintain an open mind and think about both sides of the market and the potential outcomes that can take place in the future. So the first name I want to talk about is BABA. Actually, let's start with KWEB since that's the overall Chinese ETF, tech ETF. Long ago, we already started witnessing that you see the relative strength line kind of on the bottom. It broke above, I believe that's a 21 simple moving average, Don, on your chart.
Yep.
It already showed signs mid-January that it started outperforming the S&P. And at that time, the S&P hadn't started the correction yet. But as the S&P started correcting in this 10% correction so far, this actually built higher lows and higher highs above the 21 EMA, with the relative strength line building higher lows and higher highs above its own 21 SMA. And right now we're building a huge cup with handle. You can go on the weekly, and Connor's done many segments on his favorite stage 1 base. Huge stage 1 bases can lead to massive stage 2 uptrends. And this is one still in a stage 1 base, which is why we didn't plunge in right now, which is why we're taking a starter and we're continuing to look for more confirmation and pyramid into the position as it works for us. A great rule is that you don't add to a loser. So that's what our plan is. We're going to add to a winner, especially as this starts to work. And you can see the volume patterns as well. We had that huge 2 weeks that did briefly break into stage 2 uptrend on massive volume. And even though it failed back into the stage 1 base, it was on significantly less volume And then on this right side, this recent base, cup with handle base, you see volume coming in back on the weekly. And this handle so far, we're starting to see a dry up in volume right now on an inside week. And this last 2 to 3 months of it chopping around precisely allowed those longer term moving averages and the shorter term moving averages on the weekly to align bullishly and all start rising, which you can see now. The 10, the red lines above the 20, the green, above the 30, the magenta, and above the 40, the black. So we believe that this is looking really strong, showing relative strength to the S&P over the last month and a half, building a really clean cup with handle. And yeah, our plan is to add on to this one, especially over that this handle high around $42, $43. So zooming into BABA next. Don, did you have to say something?
Nope. Excellent, Ted.
Oh, okay.
I really like that insight week on KWEB.
Right.
I also like the part where Ted said he doesn't average down. Folks, if you've got an advisor telling you to average down, run.
So zooming into KWEB, into individual name, and we believe this is the leader in China so far based off its price and volume. This is in a stage 2 uptrend. You can see BABA broke out with huge volume, multiple weeks in a row above. I can't really see that number, but that horizontal level right there. Yep, exactly. And this is living in a stage, right, 117.82. And this is in a stage 2 uptrend. And although it doesn't fit the high, tight, flat characteristics of moving up 100% and then flagging for 2-3 weeks, it did go up 80%. And for a very large, you can even consider a mega cap, that is pretty big. And we've taken note of that. Relative strength line as well, higher highs and higher lows above the 21. The weekly moving averages are aligned. And if you remember, I talked about the short segment for a couple of weeks. On the short side, you see all the moving averages on the weekly flatten out and decline. On this opposite end, where you have the stage 1 to stage 2 transition, you have the 30-40 week flattening and then turning up with the 10 and 20 above those. And this is exactly what we have here as well. And we decided to take a starter as well, along with KWEB, get some overall exposure in China stocks, and then also a little bit of exposure in what we consider is the leader. And our thesis is pretty much what Tepper highlighted months ago. China's injecting a lot of liquidity into their economy. Their central bank is lowering rates, and they're talking about stimulating the economy. So when you have the central bank behind your back, historical low valuations, plus the price action, and plus the right chart, that's when we want to get involved. As you can see, you do want to wait for the right chart because people were buying the dips and trying to accumulate for the last 2 years, and you can see how choppy that was, and likely you probably got frustrated out in the process. So this is, for us as trend followers, our style. This is pretty much the time for us to get involved. Of course, you have the value investors bottom fishing, but as you know, that's not our style, and there's always a place and time for specific style to come into favor and for those traders or investors to get involved. So the third name we also bought yesterday, a starter, is Nugget, but I'm going to talk about GDX because that is the underlying ETF of the leverage ETF that we bought, and really just a flawless cup with handle on the daily and weekly. Really just, I mean, to us, we want to wait for the pitches where when we see on the chart, it screams at us instead of kind of rationalizing, trying to find a setup. When we see these, it pops out off the page or off the screen, and we're definitely interested. You can see Don highlighted the relative strength line, cup with handle as well, and it broke out. And even so, the relative strength line is shown even stronger if you compare the relative peaks to the price, and just great action out of this handle so far. Increase in volume, and today we're following through with a higher high. And gold has also made a new all-time high, so that confirms the strength in gold overall as well. So that is the third name we took a starter in.
All right, good stuff, Ted. Let's segue over to Connor. He's going to talk about the VIX and another leading stock that we've got our eye on.
Yep. So in a volatile market, it's good to be aware of, have an expectation of the type of volatility that you can expect, And if I had to describe this market in one word, it would be volatile. And as you can just see, the VIX has been elevated for the last couple of weeks, and we've been seeing bigger swings intraday, along with overnight moves, just making it a much more challenging environment to hold things overnight. So when the VIX is over, 20, 25, it's good to have a general idea of what the type of moves that you can see in the S&P 500. So one of my favorite ways to calculate this is the rule of 16. And this is basically a rule of thumb to estimate the daily moves of the S&P 500. And how they get the number 16 is this is based on the idea that the square root of the number of trading days per year, which is 252, square root of that is about 15.87. You round it up to 16, and that's where that number comes from. And basically how you do this is you just take the price of the VIX and divide it by 16, and that's going to give you your daily range, estimated daily range of the S&P 500. And obviously this is just an estimate, right? This is a very headline driven market, so there's no saying that you get a headline market could be down or up 4 or 5%, and obviously that would fall into one of the tail outcomes. But just to summarize, if if the price of the VIX is 16 divided by 16, that's 1%. If the price of the VIX is 24 divided by 16 is 1.5%. And then at 32, divide by 16, that's 2%. And if you guys remember in 2022, when the market was very volatile, the VIX was, over 30 for some time. And that's when we were getting those huge, 2-3% intraday moves. So this is just a really, really simple formula to help you understand, be aware, and yeah, it just can help you be prepared. And this will go into account when taking position sizes. And that's exactly why we also have the ATR, the S&P 500 on the tail of the tape every day. So yeah, super brief segment on the VIX. And then the next thing I want to talk about is OKTA. And this is a stock that we bought in TurboTection today. And so basically when the market's significantly off the highs, this is not when you want to be lazy. This is the most important time to be looking for new stocks that are setting up because, we call them leaders for a reason. They lead the market to the downside and they lead the market to the upside. And so when you're down multiple days in a row, and pretty oversold, we're trying to key in on what stocks are holding up. And we always use the phrase beach ball underwater because if the market's at a position where you think that it could get a bit of a rally, well, what's the stock that's hanging out at highs that is corrected less than 10% going to do? The expectation is it would, greatly outperform the market. And OKTA kind of fit all those criterias. So first thing, it just had a recent catalyst. It gapped up 25% on 500% above average volume. It put in a day 2 higher high, and then it kind of pulled back with the market, but which is normal. And the one thing about this pullback, it was less than double digits, and you can just see on that chart how orderly it was. It let those shorter term moving averages catch up. It built higher lows. It built a tight range on the 8 EMA. And then today, it right off the open, it retook that high volume close, which is the level was about 108. And we took a starter in OKTA, shortly after the open, and our stop is that, around that 105, 106 area. That's at the low end of the range. And so basically, when the market's pulling back, first of all, the wind's not behind our back. We're well aware of that. Trend gauge tells the story there. So we're going to be taking smaller size on new buys until the market starts to act better, get more feedback on new trades. But, I kind of view this as that if I'm wrong on this trade, it's a very small loss. If I'm right, well, then we potentially have a great entry into a leading stock. And if the market starts to turn around, who knows how high this could go, but it's positioned to outperform. And like I said, if the market just rolls back over, we'll just stop out for a very small loss and try to find the other one. So definitely very asymmetrical, especially when the market is starting to, like Don mentioned, potentially follow through day significantly off the highs, trying to turn around. We're seeing some leadership, and on his screen, TGTX. That's another one that's holding up really well. So, you know, we'll see how this one works out, but that's kind of the process when the market's in a mild correction: is what stocks are at the highs, what stocks have corrected the least amount, and then once that market starts to bounce, this is when you see these stocks really accelerate because they have the wind behind their back.
Excellent job, Connor. And how's that for a segue? Get an alert pop up on TGTX, and Todd's already ready, willing, and able to discuss this as his first biotech stock that he's going to discuss. Take it away, Todd.
All right. Well, during market corrections, we're always on the lookout for stocks that are screaming at us. And this happens to be one that's been doing that. We like to search for stocks showing very positive relative strength during the corrections. And I've noticed that there have been several biotech names that have held up extremely well during the correction. And I'm going to talk about TGTX as the first stock. This is one that that I personally bought in one of my high risk accounts on 3/3, and that was on an earnings report. And one of the things that really drew me to the stock is we were basically trading under the 50-day moving average in the S&P 500 at the time, and the market was, showing some weakness. However, this stock opened fairly muted on a triple-digit increase in sales and earnings, and it just gained steam throughout the day. So I took a shot at it because I knew that they had a very successful drug for multiple sclerosis, MS. And the name of this drug is Briumvi, and it's not approved for primary MS. It's approved for relapsing, remitting MS. And what happens is after the main drug, which is a Roche drug, doesn't work anymore, they switch you to this particular drug. And apparently the relapse rate has been, or it's had a significant reduction in the relapse rate by over 80%. So the numbers are extremely positive coming out on this. But just going through the stock, you can see that last year on November 4th, they reported earnings and it launched the stock up into new high territory. And then it went into this base since last fall where it just traded in a wild range of about 26%. But on the earnings day of 3/3, it had a pretty big increase in volume of over 500% and it was up 14% on the day. And one thing you'll note, the S&P was going down during this whole time frame. As a matter of fact, this stock never once closed or even really went below its high volume close day on the earnings day. So it just really traded tight right through that range, held up. And over the last week, when the S&P was breaking the 200-day moving average, the stock really never even broke its eight-day exponential moving average. So this one looks very strong. Finally, Cowen today came out with a quick note, and they released an important nugget on the stock. Apparently, there's an increased adoption among high-volume infusion centers and academic neurologists. Notably, academic hospitals now account for the majority of growth in enrollments of this drug. That was not the case early in the launch, but it's great to hear that that's the situation now. So that tells me that the key people that study these drugs are now using this and placing patients on it pretty rapidly. So this one is probably the best looking of all the biotechs I'm going to talk about. The next one is Halozyme, HALO. This is a drug delivery system, basically. One thing that attracts me to this stock, it's a wild base, but you can see really since the beginning of the year, it's just had a steady climb, and relative strength has been improving into not new high grounds, but relative to the market, it's extremely strong. So it's just been grinding higher. You're looking at 20% earnings growth for 2025, 33% for 2026. The stock's trading at a fairly low multiple, and it just looks pretty attractive the way it's been able to hold up through the entire correction. And finally, the last stock I'm going to talk about is GenDX Holdings, WGS. This is another stock that back on October 29th had a big earnings gap that launched it into a pretty tight stage one consolidation of about 26%. Then, since the beginning of the year, it faded, traded below the 50-day moving average. But then on the earnings report on February 18th, it had a huge gap of 47.69% on a 429% increase in volume. And although it spent 1 or 2 days below the low of the gap up day, it was able to recover and regain it. And now today we're recovering and above the 20 EMA and all the short-term moving averages. So in summary, this has been a very strong group. There's over 768 names in the IBD BioTech area. So it's a huge group, but there are about 5 or 6 major standouts. And that's what I wanted to talk about.
Good point, Todd. One of the you mentioned the 700 plus in this group on IBD Live this morning. Chris Gessel mentioned that they're in the process of revamping their current industry groups, and one of the things they want to do is separate biotechs with earnings from biotechs without earnings. And critical thing that we watch is to make sure that the biotechs that we're discussing or are considering buying do have earnings and sales. And you can see, just looking at the numbers of all 3 of them that you just mentioned, that is definitely the case. They're profitable, growing earnings, growing sales, and they fit the CAN-SLIM methodology. They're not speculative. They're not a biotech that just had a phase 1 success and they have no plan of making money for the next 5 years, and they're just being bid up on hype and hope. We demand the fundamentals along with the technicals. We buy and sell on technicals and fundamentals, but we sell only on technicals because the fundamentals always look best at the top. And when stocks top, they go down on average of 72% from the highs. Great summary, fellas. Appreciate it very much. Dan, we can take it back to you.
All right, folks. Do you want the force of GroTection for your money? Let Obi-Don Kenobi help you with your portfolio so you don't have to go through 20, 30, 35, 40% drawdowns. At Revere, we've never had a bear market. Anyway, folks, listen, if you like what you heard, and by the way, we put out everything we do almost everything we do every night. The guys do a video every night the market's open for about 10, 15 minutes, going the long-term, mid-term, short-term of all the indices, stocks we're tracking, and stuff we're actually doing. Moves. You would have known we got defensive and moved to cash the last 2-3 weeks if you've been following our newsletter. Just go up to revereasset.com. Up in the right-hand corner, you can hit the subscribe button. It's a little quirky. Put your name and email address in there and hit subscribe. Next to it's a contact us button. It'll send me an email. You can ask about a stock or a topic you want discussed, or if you want a complimentary portfolio review, we do that for clients for prospects for free if you're interested in joining Revere. And we always, you can call us old school at 855 Real Wealth. And don't forget our YouTube channel. Just search for Revere Asset. Just Revere Asset and hit subscribe. You'll get this podcast before the market close on Friday. We'll talk to you next week on your money, not Wall Street's money, your money.
And may the stops be with you. because it's not how much you make in the market, how much you can keep.